Good evening, everybody. Thank you for joining me for my live stream tonight. Got some really awesome information to digest with you and to go over. So I'm going to dive right in. First of all, I'm going to talk about the new CalHFA loan program that was announced yesterday. So this is February 19th, 7 p.m. Wednesday night. This was announced yesterday, a new program from CalHFA. I want to go through exactly what it is, what it means, and what it's going to mean to you. Before I dive in, I want to give you a couple of generic updates as we get some people that are catching up and logging in. I want to cover a couple of specific things. First of all, in California, there is an issue right now going on with condominiums, and it's SB 326. And basically, all that matters is it was a law that was passed 5 years ago that became a major problem a month and a half ago. If you were thinking about buying a condominium, you need to be aware of this fact, because condos right now are a great option to get into the market when you're looking at getting something at a lower price point. The challenge is that the state of California passed a law that says every condominium project by January 1st of 2025 had to have an inspection done on all balconies and decks that are over 6 feet off the ground, and that had to be done by January 1st of 2025, and they had to do one every 9 years thereafter. Well, I'm finding now the second condominium project in a row that I've worked on that has something called a critical repair that was required. And a lot of condominium projects in the last 6 months have finally done that review, and they realized, we got a bunch of work that needs to be done. And so now they've added what's called a special assessment, where they've increased everybody's homeowners association to pay for all of these critical repairs. Well, the problem is you can't lend on the property unless I have a clear inspection that shows all that work has been done. Plus, it's going to make it a little more expensive for you when it comes to buying that condominium, because you're going to have a higher homeowners association if they had to do a special assessment to pay for those repairs. So just kind of a tidbit of information right now. If you're out in the condo market, be aware of the fact that this issue is becoming more and more of a challenge right now, where associations have really waited until the last possible minute to do this inspection of their balconies. They're finding problems, and now they're needing to rectify them. And so more and more projects are right now on the do not lend list for Fannie Mae and Freddie Mac. Now, we can get around it sometimes on other loan programs that require bigger down payments, but we can't get around this law about the inspection on the balconies. So if you're buying a condo and they have not had their balconies inspected, which pretty much all of them have, but if they don't have a clearance on there, you can't get financing in that project. So that is a major problem right now. Just be aware of it. A couple of things about Dream for All real quick before I dive into this program. I know I've got a lot of people who are Dream for Allers. Maybe they're on the wait list, but I want to share with you really quickly. I did find out today, and those of you in LA County probably already know this, they are granting special exceptions to get additional 30-day increments on your voucher. If you're in LA County and you tell them that you were impacted, or not just tell them, but that you were impacted by the fires, they're giving you extra time. So maybe you're impacted because of the minimal amount of homes that are available for sale, because of the people who lost homes in fires are coming in and eating up that inventory. So just a side note for those of you in LA County. All right. Maria, I will get to your question. Post your questions. If you have any questions, I'll get to them as we go forward. If it has to do with exactly what I'm talking about, I'll talk about it then. Maria, I'll cover your question in a few minutes. The other thing, Dream for All is lasting a lot longer than expected. And there's really a couple of things that I want to be clear about why that's happening. For those of you on the wait list, I'm seeing the wait list move down faster than I had expected. And I'm not trying to give a lot of hope to people who are way down on the wait list, but at the same time, I'm opening up a little more hope than anything that I had before. So let me explain really quickly. CalHFA they did a board meeting last month. And during their board meeting, they outlined, and I'm going to share with you guys really quickly here. They outlined, let's open up this entire screen and share that right there. They outlined for the year of 2024, January 1st through December 31st, how many loans were done and in what regions. So they mapped out the regions here, nice colorful breakdown of the regions. And what they're showing is the My Home program, they had 5,300 people utilize the My Home program. And they show the regional distribution here on where the money was used. The biggest area was the Central Valley, which is normally a pretty heavy user of all down payment assistance loans. Capital Region is also a pretty heavy user of all down payment assistance loans. And Inland Empire is second place, actually. So what you're finding is a lot of people who live in high cost areas are moving into the Central Valley, moving into the Inland Empire to find out or to find ways to use these programs. And the ADU grant program was really small, so that one really isn't something I want to talk about. But Dream for All, what they're saying right here is the pull through for Dream for All. They had 1,103 homeowners that they funded loans in 2024 for Dream for All. Now, we thought there was going to be 1,700 vouchers, but that's only if everybody used the $150,000. Plus, I found out that some people have already paid back their 150 grand or 100 grand. There are people who literally took out the Dream for All money in the last 6 months, and they've already paid it back. So that money is being recycled back into the current fund of money. So we're seeing, I said it before, like Orange County has the highest pull-through percent in dollars at about $122,000 per voucher. Most other regions are significantly lower. So what we're seeing is 1,100 of the 1,700 that we originally thought were going to be used, and that number is going to be significantly higher. I'm thinking closer to at least double this. So if it took 6 months to go through the first group and we had 1,100 people who successfully purchased, and now we're into the third round of funding. We had, again, the June people, then we had the September people, now we have the December and January people. And through December 31st, we had only used about half the money. But here's the other key that I want you to pay attention to, which is CalHFA is finding that this is a small pool, but when I talked to somebody, they said they had called 50 people in the month of January that had just gotten their voucher. And of the 50 people who had just gotten their vouchers, half of them said they had already purchased or weren't interested in buying, or they don't qualify anymore because these are stale applications. They had applied for this loan back in April of last year. Here we are almost a year later. Things have changed. Their income's gone up too much. They've lost a job. They've had changes in their credit. So what I'm finding is they're burning through vouchers really quickly in this second half of Dream for All. So this money, the first winners, they fought really hard. They wanted it. They applied for it. They were waiting for the first round of money to come out, and they were ready and raring to go. Very few people gave up their vouchers. But now I'm hearing more and more people who have gotten vouchers in the last month and a half are saying, sorry, I don't want it anymore. I already bought something. A lot of them, I know a lot of people on the wait list that end up using me to buy using a different program. So just if you're on the wait list, I'm actually seeing more optimism than I had seen previously. So that's really, really good news for those of you who are on the wait list. I've got another question here. Let's see if it's pertinent. So Okie Dokie says, my numbers moved 7 to 10 spots every week for the last month. Andy Hong says, any chance I'm at place number 25 in Orange County? It went down from 31 to 25. Andy, I think you have a great chance. I think that there's more and more people who aren't finding homes. I have voucher winners from the October voucher release that haven't been able to find homes. So I do think you have a pretty good chance to be able to get a voucher if you're down at 25 in Orange County. Again, I can't promise anything. So Andy says, yay. I agree, Andy. I'm saying yay for you as well. Obviously, guys, I'm guessing, but I feel a lot more optimistic than what I had felt before when it came to Dream for All numbers and your opportunity being on the wait list to get a voucher. Now, those of you in LA County, you can be happy for your peers who have a voucher that are going to get extra time, but you also might feel a little frustrated that the people who have a voucher right now, they're being given extra time. They're getting extra 30-day increments if they've been impacted by the fires. Some people are going to say they've been impacted by the fires when they weren't. I also heard from CalHFA, if they're calling and not reaching somebody, they're going ahead and telling them they're going ahead and extending them, because if they don't hear from somebody, they're assuming they were impacted by the fire. Okie Dokie says, I was 356 when it first dropped. Now I'm 122 in the Central Valley. The Central Valley has had the biggest usage. So if you look at the Central Valley, 14% of the vouchers were in the Central Valley. Okay, 14% of the vouchers that were used were in the Central Valley. Let me show you this document right here. So this is my original numbers that said, hey, Central Valley, 21% of the money in 2023 went there. It's only 10% of the region. So 10% of the state's population is in the Central Valley, yet 14% of the vouchers that have been redeemed statewide are in the Central Valley. So as much as I would say, okie dokie, that, hey, you're in the Central Valley, what do I think? I think you got a good chance, but I also think that the Central Valley itself has had a high penetration, a high utilization of people. So I don't know how much is left in the tank, because remember, the remaining vouchers, even though half of the vouchers are remaining as of January 1st, they aren't equally distributed. And the truth is, a lot of them are in LA, because LA County represents 25% of the state's population, and yet only 16% of the vouchers so far went to LA. The other real big surprise is the rural areas. So rural areas only represent 4% of the state's population, yet I don't even understand how these numbers work. Let me make sure I didn't type that wrong. Rural areas, dream for all. I did. Haha, I typed it wrong. All right, it was 5%. I just somehow didn't get rid of the 2. All right, that seemed crazy. So rural areas are 5% of the usage, and it's 4%. So the rural areas aren't much of a surprise. All right, so let's get rid of that. Let's stop sharing this for a second. And then I'm going to dive into the new program here in just a second. How much longer is the DFA program going for on this round? We don't know until it runs out. They are aggressively issuing vouchers. They're aggressively asking people to cancel if they're no longer shopping. They're calling and following up with people as they get vouchers to make sure that they log in and they download their voucher. They didn't do this the first time around. So they are aggressively pushing to get the vouchers out. Their goal was to have all of the money out by June 30th. I don't know if they're going to hit it, but that was their goal. Okay, so we will see what happens with that money. Here's the other thing that everybody asks me is, hey, John, when's more Dream for All money coming out? So I want to be really clear. Nobody knows. Nobody knows. Nobody knows when. I can't sing. Nobody knows when the money is coming. But we do know that it's appropriated by the state during the budget that comes out every year in June. So we will know in June whether it's on the table for next year. So next year would be between July 1st of 2025 and June 30th of 2026. So we have no idea, but there's no money coming this spring. And really, even if they allocate it in the summer into the budget, it's probably going to take CalHFA 3 to 6 months in order to get the lottery out and get everything done. So we're probably looking at money that's available early next year. Okie dokie, one last question. When will the next DFA 90 days run out before more vouchers are issued to the wait list? As we heard, who was it that said it? Somebody said, you said it. You said that your numbers are moving 7 to 10 points every single week for the last month. So there's the next round, major round of vouchers is going to expire on March 30th approximately. So these are people who got their March 20th maybe, because they got their vouchers. The first big round of vouchers that were issued were when the first 90 days of winners expired. So we're going back to June 28th is when the vouchers were first issued. 90 days after that was like September 26th. So a day later, September 27th, 28th, given the weekend schedule, I think it was that Monday, they dropped a whole bunch of vouchers. And so those people had 90 days through the end of December. So December 25th, they moved it to the 26th. That was their 90 days. They all got a free extension. So they all got 90 days from Christmas. So now we're talking about March 20th, March 24th, somewhere right around there. So that's the next expiration of vouchers that we're going to see a big drop. But we're seeing so many vouchers that were issued in January that are being, given up, that they basically go in and reject their voucher and they say, I don't want it. And so we're seeing a lot more vouchers coming up a lot faster, like you said earlier in your comments. All right, so let's dive in now to this new program. So I want to be really, really clear. I've studied this new program a lot over the last 48 hours. It was launched yesterday. So if you are on CalHFA's email list, oops, let's get rid of that. And you would have gotten this email from CalHFA yesterday morning. So it came to me at 7 o'clock yesterday morning, and it was super confusing. Like, what the heck does all of this mean? I received a lot of calls from people yesterday, a few more calls from today. I want to be really clear. I'm going to explain to you what this means, because this is all mortgage speak, like a taxable bond program. What the heck do taxes have to do with any of this stuff? And what does this all mean as far as, okay, so there's a CalReady conventional and FHA and a Cal Plus Access conventional and FHA and a MyAccess program. And what the heck does all of this mean? Well, I'm going to break it down for you and make it really, really clear on what it means. It means it's easier to get more assistance. What they're trying to do is they're trying to help take the program that they have currently, and they're going to make it easier to access depending upon the interest rate market. That is the simplest way that I can say it, but I want to make it really, really clear what it means. Right now, if you are not a Dream for All buyer, the best assistance you can get pretty much anywhere, whether it be from CalHFA or with the GSFA Platinum program, is going to be with up to around 5 to 5.5% of the purchase price in assistance. That will help you with down payment. That will help you with closing costs. CalHFA's method in general is better than the GSFA Platinum method. I'll explain in a few minutes what GSFA Platinum is, give you kind of a refresher on how that works. CalHFA has a great program where they'll tie either a conventional or FHA first mortgage with a My Home second. That gets you 100% of your purchase price. So you need 0 down payment. And then CalHFA said, hey, if you need help with closing costs, we will add a zip loan. So we'll give you a zip loan to assist you with your down payment. And so those are your 3 loans that add up to allow you to get the 100% of the purchase price, 0 down. And then you can add the zip loan in order to get help with some of your closing costs. What they've added now is instead of the zip, you can go a different direction, and it's called the MyAccess loan. So the MyAccess loan, I'll share a little bit of information about this right now. So let's go here. All right. So the MyAccess loan is 2.5% of the purchase price. So if you're getting an FHA loan, your My Home is going to cover up to 100%. It's going to be 3.5%. If you're getting a conventional loan, your My Home is going to be 3% because it still gets you to 100%. So just think CalHFA with either an FHA or conventional first, and the My Home program will always get you 0 down payment, but it won't help you with closing costs. The MyAccess program will give you 2.5% as a loan towards your closing costs, but only after using My Home. You wouldn't want to use this first. The My Home program always is your down payment assistance. MyAccess is your closing cost assistance. Now, there's likely going to be a bump in the rate on your big loan, but I don't expect it to be that bad. Matter of fact, I expect these rates to be a lot better than what we're seeing right now, and I'll explain that to you. That's actually the win on this program. This program is all about the interest rate that you're getting. Cool thing is MyAccess loan only charges 1% simple interest, just like the My Home loan does. So it's very, very inexpensive money. Again, I'll go back here and see if these questions are pertinent to what we're talking about right now. Andy asks, does this work for Dream for All? It does not. So it is not going to go in addition to Dream for All. This is for people that are either not eligible, not on the wait list, or don't want to wait. This is an alternative, but this is not in addition to Dream for All. All right. So that is, so it's an alternative to the ZIP program. So I want to explain to you something, and this is I'm going to be kind of, I don't know. I'm going to try to keep this high level, but I want to explain to you what's changing, because this right here is, in my opinion, going to be the biggest piece of news about this program. And it's the difference between TBA and MRB. So what the heck are you talking about, John? TBA is, let's go here. All right. So TBA means to be announced. But really what it is the mortgage industry works this way right now. And I need you to stick with me for a minute to understand this. When you buy a home and you call me and say, John, I want to lock in my interest rates, we freeze your rate today, but we actually don't know what rates are going to be at the time that we sell the loan to Wall Street. Wall Street ultimately buys your loan, and we don't actually pool it up and sell it to them because we package it together like a mutual fund and we sell it to Wall Street. Well, Wall Street they aren't buying loans before they're funded. They're buying them after they're funded. And so we have to lock your rate today, guessing what the rate's going to be in 2 months when we actually sell it to Wall Street. And so that's called securitizing. So we don't know the rate of the market until we actually complete the purchase in about 30 days after you have your keys. So the loans that we are selling today to Wall Street are loans that we locked 60 days ago on average. So how do we handle it? We buy an insurance policy called a hedge. Okay, so a hedge, we're hedging our bets. We're hedging against the market changing. So if rates go up, we actually get paid back some money from the insurance policy to make up for the fact that rates are higher. If rates go down, then hey, it's a win because we've locked you at a higher rate and rates went down. But we owe money back to the hedge, and so we didn't really make any money. That's how the world of mortgages goes around. But there's a lot of risk in there. It's very market sensitive, and hedging costs can get very expensive. So the only thing I want you to understand from all of this is all normal loans, we are locking a rate, guessing where the rate is actually going to be, and we're buying an insurance policy to cover the time in between. So the bank is not making any more or less money if the rates change. Our insurance policy is covering that. But the rate market being this volatile makes the insurance cost very, very expensive. MRB stands for a mortgage revenue bond. That is what CalHFA has done. That is what they've announced, is we're going to also now issue mortgage revenue bonds. It has been 14 years since they've done this. 2011 was the last time that CalHFA issued a mortgage revenue bond. Well, what does that mean? That means that CalHFA has already gone out and borrowed money from Wall Street. CalHFA has borrowed $50 million, has already been secured. So they already know what the interest rate is on that money. They've borrowed it already. They have it in the bank. They're waiting. It's like a big old line of credit that they've already taken out. And your loan, when you lock your loan, will be part of that pool that's already been bought. So there's no hedging. It's less volatile, and CalHFA can pass along lower interest rates because it's not locked loan by loan. It's locked with the backing of the state agency, and they have access to money cheaper than what mortgages would be locked at in the normal market for a TBA delivery, for a TBA type of loan. It's less volatile. The spread is much better. And I'll explain to you what the spread is here in just a second. Okay. But I want to, first of all, explain to you today's options. You only have the option of either a conventional loan, getting 97% from Fannie Mae, 3% from My Home, and then a 2 or a 3% zip. That's a total of 103%. So that covers down payment plus 3% towards the closing costs if you took the 3% zip. The other option today is FHA. FHA, you're borrowing 96.5% of the purchase price. You have a 3.5% My Home loan, so that's 100%, and then you're getting the 2 or 3% zip. It's still the same 103. You still have your down payment covered plus 3% towards closing costs. Here's what's changing. That whole worksheet that you saw, that whole email that went through all of these, hey, we got this program and that program, and we can do this and we can do that, is boiled down to this. Next month, March 17th, we're going to have the same thing. A conventional first, 97%. A 3% My Home. That means you have 0 down payment, and a 2.5% MyAccess loan. Total of 102.5. It covers your down payment plus 2.5% towards closing costs. FHA, same thing. Your FHA first and your My Home second is 100%. You have 0 down payment required. And then you get the MyAccess loan for 2.5% of the purchase price. So what's really changing? Interest rates, interest rates, interest rates, interest rates. And the TBA may be better. So the old version is still going to be there. When rates dip, the old version, the version that has the zip loan, is probably going to have better rates. When rates are high like they are right now, the mortgage revenue bond, the MyAccess program, is going to have better rates. What it gives us is the ability to choose every day based on where the market is at. That is going to be the game changer. So let me explain to you how this looks on CalHFA's website. I want to really give you guys a breakdown of what this is going to look like. So let's find this page, right? What am I looking for, John? I don't know what I'm looking for. Let's see. Nope, that's not what I'm looking for. I am looking for, let's just go right here. And let's go to CalHFA, and let's go to their interest rates. So we're going to go to CalHFA right now. We're going to go to rates and reservations, and we're going to view today's rates, okay? By the way, you can do that even though it says for lenders, you can click on it. There's no like super secret password, super secret handshake, etc. All right. So what you're seeing here is you're seeing CalHFA's conventional with no assistance. No point in doing that. CalHFA's conventional with down payment assistance only, meaning you are getting zero down, but you have to pay all your closing costs. Or you can get CalHFA's conventional loan with a 2% zip loan. But to get 2% as a loan, not as a gift, as a loan, you're paying more than 0.5% extra per year in interest on your big loan, okay? More than 0.5% extra on your big loan. What that looks like right here, oops, I never finished my, all right, yeah, that's fine. So what that looks like right here is this scenario. So it says, hey, you could get 6.875 if you just did the loan with My Home, okay? So if we just did this one right here, you'd have a rate of 6.875. By the way, always look here unless you are low income, and I'll talk to me and I'll help you understand what the income limits are per region to decide if you're low income. But you're looking on the left for the standard rate lock, you're at 6.875. So 6.875 on a $500,000 home with 3% down, because this is a conventional loan. You're looking at a payment before taxes, before insurance, before mortgage insurance. You're looking at a payment of $31.86 a month. If you wanted 2% extra, that's going to give you an extra $9,700. You're paying $200 a month extra. That is a lot of money to pay extra. Now, if you need it, you need it. Now, if you're going to 2%, you might as well go to 3%, because it's only an extra $83 a month to get to 3% instead of 2%. So you're getting an extra $5,000, and it's only costing you $80 a month. The first 10 grand is costing you $205. The next 5 grand is only costing you $80 a month. But then we go down to FHA, and this is the problem with the current process, is that FHA and conventional, sometimes there's just no option for them to bump the rate enough. So in FHA, what we're seeing is a base rate of 6.5. But to get 2% in help, you have to go from 6.5 to 7.6. So think about this. You're borrowing 2% extra upfront that you have to pay back. And in exchange for that, you're paying over 1% extra per year. That makes the zip loan, the current method, not a good deal. And you can't even get 3% in help because there isn't 3% as an option today. This is what the MyAccess program and the mortgage revenue bond is going to change. And I've got it on good authority that the rates on FHA are going to be pretty stellar. Now, stellar, don't misunderstand. A stellar in my world means that if normal rates are at 6.5 and we can get you, 6.1 and get you some extra help for 6.5, well, that's way better than having 6.5 with extra help being 7.6. I'm not quoting you rates. I'm giving you a concept. Right now, what I'm being told is this new mortgage revenue bond program, it's not looking like it's going to be very attractive for the conventional loans, but it's looking like it's going to be super attractive for FHA. We're not going to know until rates come out on March 17th. Excuse me. So you can join me on St. Patrick's Day. I'll explain this all to you when those rates come out. But bottom line is, this is what is changing. It is not more assistance than you could get today. But nobody did the zip loans because the bump in interest rate to get a zip loan is super high. It wasn't worth it. So what it is it's the same amount of assistance you could have gotten, but actually reasonably usable. That it is a program that's going to have reasonable interest rates and allow you to get extra help. So it's a really, really good program, and I want to make sure that you guys fully understand that. So at this point, I'm going to look really quick to see what questions I have. I am going to talk about alternatives just to help you understand what that looks like. But before I do that, the Art of MD says, is there a limit to how much you can buy down the interest rate? Yes, there is. So our wonderful state of California legislature has rules about usury is really the term, but it's basically me as a lender taking advantage of you as a buyer, or the mortgage industry taking advantage of you as a consumer. And so they set limits that said, hey, you can't buy down more than a certain dollar amount. I had a client last month. They bought they used Dream for All. They bought a condo in the San Francisco Bay Area. It was about $1.2 million. With their down payment, they were borrowing just under $1 million. They wanted to buy down their interest rate. They felt most comfortable doing that. We had decided the day they locked, rates were not good. We were at like 7.125. Actually, not that much worse than today, because today Dream for All is at 7. But we locked their interest rate, and we looked at the chart of buy down options. They said, you know what? I want to buy down to 6.25. And I said, great, no problem. I told CalHFA, okay, can we buy it down? And they said, of course you can. Here's the chart. CalHFA gives us options to buy down the interest rate all the way down to like 5.25%. But the state of California, which you'd say, well, wait a second, John, isn't that CalHFA? No, the state of California has a different set of rules through compliance side of things. And so we ran it through those compliance tests and it said, no, the buyer's not allowed to pay that much money in fee. So either get a seller credit so the seller can pay it. That's the trick. If you want a big buy down, get the seller to give you a large credit. Okay. If you can do that or any kind of a seller credit, the money that we're paying on the buy down from the seller's money doesn't count towards the state's limit. But there is a limit. In this case, we couldn't buy her down as far as she wanted. We had to raise the rate 1/4%. She paid less in fee to get there, but we weren't allowed to buy it down. So there's absolutely a limit to how much you can buy down the interest rate. All right. I know Maria asked a question in the beginning. She said, if we have a Dream for All voucher expiring at the end of March, can we file for an extension already? And by then, should they be submitted? So here's the deal with the extensions. You only are going to get one unless you're in LA County, okay, because of the fires. And there's no guarantee how long they're going to keep extending the vouchers in LA County an extra 30 days at a time until the foreseeable future when they deem that the fires aren't impacting those home buyers in LA County as much. So if you have never gotten an extension, Maria, 30 days before your expiration date, when you log into the Dream for All voucher portal, it'll give you the option to request an extension. And within 24 hours, they'll get you a new voucher with 90 more days. So if you got your voucher at the beginning of January and you expire, or end of December, and you're expiring at the end of March, you can extend around the end of February. So you got to wait until you're within 1 month of your expiration date. If you got your voucher in September and you extended in December, and now you're expiring in March, that's it. There are no more extensions allowed. That is your only extension that you are given unless you are in LA County. All right, I'm going to shift. If you have more questions, by the way, please ask them right now. I am going to cover what alternatives there are, and then I will let you guys go. So if you have questions, now would be the time to ask them. So what I'm going to share with you right now, first of all, is the new website that I'm in the middle of creating. I got some pretty good stuff on there, so I'd love for you to go there. It's johnloneking.info. So let's do this right here. All right, cool. See, you get to see multiple of me. All right, so you go to johnloneking.info. And you're going to click right here saying Dear Home Buyer, and you're going to be able to see, and there's stuff here you can see, and it's got links to some YouTube videos, etc. But you click Dear Home Buyer, and it's going to take you over to a page that we've created, kind of walking you through the home buying process and trying to figure out what loan program is right for you. And what I want to show you, by the way, this is, as you go here, I'm building a guide for lots of different loan programs that are out there. The My Home, and I put in the next couple of days, I'll put information about this MyAccess program, GSFA's down payment assistance program. And so I'm going to show you, for example, the GSFA. Let's go here, and it talks through all of these programs. So GSFA can offer up to 5.5% of the purchase price in assistance, but GSFA is very market driven. And so I have a link right here that says GSFA Platinum interest rates. The cool thing about GSFA is you don't have to be a first-time home buyer. That's one of the biggest cool things. The second thing is if you're doing it, if you exceed income limits on all these programs, you're like, John, I know I have a good job, but it's a bonus I get once a year, and I don't really make that much money on the regular, and I really need down payment assistance. GSFA's Platinum FHA loan has no income limits. But here's the deal. Here's how their rates work. You click on here and you will see their interest rates. And right down here, I've got a live link on my page to GSFA's interest rates. And what you'll notice, and we'll just go right down here at the bottom, this is Freddie Mac's conventional loan where you're over 80% of the area median income. And what they're saying is, hey, at a rate of 6.875, you get 3.5% in assistance. Well, let's see. CalHFA is saying at a rate of 6.875, you get the My Home with 3% in assistance. Pretty close to the same amount of assistance. But the key is the Platinum program makes you make a payment on that second. So you're writing a check every single month to pay down towards that assistance loan. And the rate on the assistance loan is the same as the rate on the first mortgage. And if they say, hey, if you want more money, if you want an extra 1.5%, you're going to go from 6.875 to 7.375. So that's giving you a total of 5% of the purchase price. Well, CalHFA, if you wanted 5% of the purchase price, you're basically going to be at 7.5%. So you're going to get the 3% My Home, and then you're going to get 2% as a zip at 7.5%, which is basically more expensive than the program is with GSFA. In other words, there are alternatives, but CalHFA is the best option that I know of that's out there. It provides you the assistance money that you do not have to make payments on. So if you want more information about this, you want to check out my blog, go to johnloneking.info, and you can get the link right, or you can actually see all of this right on there. I'll be adding more and more to those pages. All right, so it looks like I have one more question, and then if you have more questions, ask them now, because once I answer this, I'm going to sign off unless you have more questions. So the Art of MB says, is the GSFA loan more expensive than CalHFA because of the 15-year subordinate loan? Twofold. A, yes, it is more expensive in monthly payment because the subordinate loan, the second mortgage, you have to make payments on. So with CalHFA, their second mortgages, you never make payments on. You never pay a single payment, and the interest that's added is little tiny bit. It's like 1% per year, and it doesn't even compound. So if you got $10,000 in assistance from CalHFA, you're adding $100 a year, $100 a year. It's 1% per year. It's $100 a year on 10 grand. That's it. Versus if you do the GSFA Platinum, your interest rate on that second matches your interest rate on the first. So if your interest rate on the first is at 7.375 or 7.125, that's your interest rate on the second. So it gets very, very expensive. And then the upfront cost, there is the revenue that is paid by GSFA is 0.5% less to the mortgage lender than what is paid by CalHFA. So most banks, including mine, charge 0.5 point extra in fee for the GSFA Platinum loans. So it ends up being not only a higher payment, but it ends up being a higher cost, and in most cases, a higher interest rate. So very rarely am I going GSFA unless you're not a first-time home buyer. This is great if you're not a first-time home buyer, or if you are what the heck was the second thing? Not a first-time home buyer. Oh, if you exceed the income limits for the other programs, it's a fantastic option. And then the other thing about GSFA Platinum is it does have a grant component. So if you are an employee of certain counties in the state of California, or if you are a medical healthcare worker, first responder, firefighter, police, or educator, then you get a portion of that assistance money as a grant. So there is a benefit over there, but you're paying a payment on the second to get some grant money. I'm not sure if the trade-off is worth it, but hopefully the Art of MD, that makes sense. And if you have more questions about that, feel free to ask. All right. So I've got one more question right now. Andy says, what will the DFA interest rate likely be? So we know what the interest rate is. It's changing daily. So if we go right here, let's make this bigger. Let's go over here to CalHFA's rates. So the Dream for All interest rate today is 7%. It's been bouncing around. So if I give you a high level history of what I've seen in interest rates over the last 8 months since the Dream for All program came out, what we're looking at is they started right around 7. Like when they came out in June, we were right around 7, bounced down to 6.8, up to 7.1. And then by the time we hit August, rates had tickled down into the high 5s. So you had rates a couple of days. We had interest rates on Dream for All at 5.875 and 5.75. I think it was 5.75 is the lowest we hit. But that was also the lowest that the mortgage market hit in the last 3 years. And then they started taking off again. And so we saw rates settle in the mid to low 6s in early fall and heading into winter. And then we've seen them move up even higher. And so we've been tickling 7. I had one client, we locked at 7.375. Locking is the most frustrating part of this process, especially with a program like the CalHFA, all of the CalHFA programs, because you have no idea what tomorrow is going to bring. And so when you get into contract, I can give you all the advice I want about where I think the tea leaves are going, but it's really no different than your financial planner saying, I think Tesla is going to go up or down tomorrow. But who knows? Nobody really knows what's going to happen. And so as rates are moving up, and I have had clients, and I had one last month in January, we locked her at 7.375. She bought it down to 7.125. And then the day after we locked, rates fell to 7.125 without a buy down. We locked. There's nothing we can do. You can't unlock. You can't go back and say, I wish I didn't. You can't undo the decision that was made. Just like if you don't lock, you can't undo the decision and lock because, oh man, I wish I would have locked yesterday. Can we go back to yesterday's numbers? Remember, on all of these loans, we are locking the rate today based on where loans are at today, but we actually aren't freezing the loan with the investor until 2 months from now. So we're buying a hedge against rates changing. And so if, once you lock, we've bought the hedge. And so if rates fall, we owe money on the hedge. So you would say, well, man, you're collecting a higher interest rate than you should. You're making extra money. By the time you sell it to Wall Street, rates are lower. Yeah, but we end up owing money to the insurance policy. So we're not making money. The moment you lock, we buy a hedge. Therefore, there's no extra money for us to make or lose. It's part of the insurance hedging process. All right. Andy says, thanks. The Art of MD says, GSFA offers higher DTI than CalHFA. I believe you can qualify for more. Only on their open doors? No. Golden opportunity. No, it is open. No, it's golden opportunities. GSFA Golden Opportunities Program. So the Golden Opportunities Program gives you higher debt to income ratios. So I'll share my screen again and go through that part with you. So you're kind of correct. They won't go up to 55% except for the Golden Opportunities Program. And the Golden Opportunities essentially offers, they now will do Freddie Mac, although I don't know if they'll go to 55. They won't, because Freddie Mac won't go to 55. So Freddie Mac by design goes to 50. We can't go higher than what the investor will allow. So we have Ginnie Mae, which is FHA. FHA technically will allow up to 56.9% of your income to be spent towards your debts. And the Golden Opportunity Program says we'll let you spend 55% of your income towards your debts. So that is where you have more wiggle room on the Golden Opportunities Program. I have all of these tools in my bag of tricks, but it's also going to be a much higher cost. So if you're looking at the Golden Opportunities, let's just compare FHA apples to apples. To get 5% in total help on Golden Opportunities, you're at a rate of 7.625. If you are looking at the Platinum Program, to get 5% in help, you're looking at 7.25. So it's a significantly higher interest rate on the, and I know this is small, so I didn't, anyway, you guys follow along, but I didn't realize it had it still in small mode, but it's a significantly higher interest rate. So yes, you can go higher DTI, but you're paying a higher rate for the benefit. All right, Andy, last question. I know that you will need to keep the house as your primary residence, but can you rent out rooms in the house, or after a certain time, can you rent out the whole property? So you can rent out rooms anytime you want. Lenders won't count that income. So when you come back to me a year or two from now and you're saying, hey, John, I want to count border income, there's very rare circumstances we can count the income for qualification. But you can rent out rooms right away because you're still occupying the property as your primary residence. Nobody can stop you from renting out rooms from the house that you own. We just can stop you from moving out. And the truth is we can't stop you from moving out. Okay, it's called mortgage fraud. You could technically get prosecuted by the FBI. I'm not telling you to commit mortgage fraud, but fraud has to do with intent. And so if you buy a home and you have the intent to occupy for a year, and 3 months after you purchase the home, your job transfers you to Texas, you can rent out the property. You can rent it out because it's really clear that you didn't know you were going to get transferred to Texas when you bought the home. And you got laid off and then you found a home and the new home's in Texas. That's even more of a clear, like, look, I didn't plan on getting laid off and I needed to work. And so I'm moving to Texas, but I don't want to sell the property. You can rent it out at that point in time. It's about intent to occupy. Now, if you come to me 6 months after you bought a house and say, hey, John, there's another house I like better down the street. I want to buy it instead, and I'm going to occupy it. I'm not going to let you do the loan on the next house. That's how we stop you. I won't let you do the home loan on the next house because, hey, you're still supposed to be living in that one. And so you violated the rules on that one. We're not going to let you off the hook by giving you a new property. But we actually can't stop you from renting it out. We could prosecute you for mortgage fraud. I don't know if it would really happen, but we could prosecute you for mortgage fraud if we felt like you did it on purpose. So I'm not telling you to buy something and move out and rent it out. And I'm not telling you that's okay because you are committing mortgage fraud if you intended to do that. But if circumstances caused that to happen, you didn't commit fraud. Life happens. Things happen. So your circumstances change and you needed to rent out the entire property because you can't live there anymore. And Andy, yes, he says, does that hold true with Dream for All? It holds true for all loans. The truth is the Dream for All program, they can't force you to pay back a second mortgage, even if, like they've said, hey, if you move out, you should pay back your dream for all money. You should. Sure, you should. But we all should pay as much in taxes as we possibly can. But if you got a good CPA, you get some good write-offs, you don't pay as much in taxes. So on Dream for All, the same thing, intent to occupy. If you didn't try to defraud the system, but you end up needing to move because of circumstances beyond your control, rent out the property. We can't stop you from doing that. The words are in the documents, I intend to occupy within 60 days, and I intend to maintain occupancy for 1 year thereafter. That's what you're signing to be true. If that is the truth, the moment you sign the documents, you didn't commit mortgage fraud. If life happens, now not, well, John, I didn't intend on renting it out, but I found something I liked better. That's not going to hold water. Okay. So you have to have a real circumstance that makes the property uninhabitable for you. I had a client who unfortunately had a family member that got very sick and passed away. And they ended up adopting 4 children that they didn't expect to have. Their current house didn't work for them anymore. That has nothing to do with intent. Like, they didn't intend for that to happen. They didn't intend for the situation to come up where they adopted family members that they didn't expect because somebody passed away. So the fact that they had to buy a different home and move out and rent out the home that they were in is fully acceptable because they didn't commit fraud. You just have to be able to prove that's what happened if anybody asks. So that's really the key. All right, gang, I appreciate your time. If you have any other questions, feel free to reach out. Otherwise, Andy says, yes, that means it helps a lot. I am happy to help you guys. I want to be super clear. I am interviewing for the job to be your lender. So that is 100% what I want to do. I'm going to go right here and say, let's make the smaller one. All right. So if you're still here, thank you. If you want to talk with me, please scan the QR code above, download my mobile app. There's a link there to schedule an appointment. You can go to johnloneking.info. I know it says .com right here. That is my company website. johnloneking.info is the site that I've created with a lot of content about different programs. And I'm adding more and more content as I go forward. Lots of links going back and forth to my YouTube channel and johnloneking.info. But you can schedule a consultation right there. I am interviewing to be your lender. So if you are in the position to want to buy a home down the road, if you end up as a homeowner, you want to refinance or pull equity out of that home, or you know anybody in the world who is in that position that needs a lender, I am right now interviewing for that job. That is how I get paid. I don't have enough YouTube followers. I make zero money from YouTube. It's really sad, but I do get paid doing mortgages. So I am interviewing for the job to be your lender. If you found that I provided value to you, please pay me back by reaching out to me and allowing me to help you with your financing. That, ladies and gentlemen, is how I get paid. Thank you so much for listening, everybody. Hope you have an absolutely wonderful night, and we'll talk to y'all soon. Bye-bye.